Have you ever stopped to think about what Wall Street has to do with the person who comes to fix your air conditioner? It sounds kind of out there, I know. But there is a multi-billion-dollar bet being placed on your AC unit, and today we are going to break down exactly what's going on.
I mean, it seems a little random, right? Why would some giant financial firm on Wall Street care about a local Main Street business? Well, it turns out there's a massive and, frankly, kind of risky financial strategy playing out right in our own backyards.
So that brings us to our first section, Wall Street's HVAC obsession. Yeah, you heard that right. We're going to dive into this really unexpected connection that's been generating huge profits for some of the biggest investment funds in the world. Okay, so here's the deal. You've got these major players, private equity firms, you've probably heard them called PE for short, and they have been on an absolute shopping spree. We're talking about them quietly buying up thousands of small, independent heating, ventilation, and air conditioning businesses all across the country. But you have to ask, why are they doing this? It's all part of this very specific strategy, a playbook they call buy and build. It's basically a method for turning a whole bunch of little shops into one giant payday.
Now, the official term for this whole thing is a roll-up strategy, and the idea is pretty simple, actually. You take a market that's really fragmented, like HVAC, which has just tons of independent players, and you consolidate it. You buy up a whole bunch of small companies and then combine them into one, much larger, and hopefully more valuable one. So the process really works in four key steps. First, the PE firms go out and acquire all these small businesses, often at a pretty good price. Then they combine them, streamlining everything from billing to marketing to make it all more efficient. This creates what are called economies of scale. All of a sudden, they can buy parts in bulk and get huge discounts. And the final step? They sell that new giant company for a way higher price than the sum of all its little parts.
It's that classic idea, right? The whole becomes worth more than the sum of its parts. By rolling up all these companies, investors are betting that one big company with 1,000 technicians is just seen as way more stable and profitable than 1,000 separate one-person shops. But here's the thing. This entire model has a pretty big potential weakness. It introduces this core risk that could unravel the whole thing. I mean, the strategy works beautifully when the market is hot, but what happens when the market cools down? You see, the entire model hinges on one single critical assumption, that the HVAC market is going to keep growing, consistently and reliably. The machine needs that constant fuel to keep running. And this brings up the billion-dollar question. If demand for HVAC services suddenly drops, if the economy slows down, what happens to this massive, carefully constructed financial machine? And that's what we're going to explore right now. Because when the market turns, the whole strategy comes under threat, and you start to see these cracks appear in a couple of very specific ways. So when a downturn hits, the strategy faces two core threats. First, the roll-up model itself starts to falter. And at the exact same time, this immense financial pressure starts to build. Let's start with how the roll-up falters. So how does the growth engine just stall out? Well, first, in a downturn, small business owners get nervous. They might decide not to sell, which leaves the PE firm with fewer companies to buy. At the same time, the benefits of being a huge company are reduced if your overall revenue is shrinking. The entire growth plan just slows to a crawl. But that's the slow burn problem. The immediate five-alarm fire danger comes from something else entirely: the massive amount of debt, or leverage, that was used to buy all of these companies in the first place. Okay, here's the danger in a nutshell. In normal times, the company's cash flow is high, more than enough to easily cover its debt payments. But in a downturn, that cash flow drops, and it can potentially fall below the level needed to pay its loans. And that's when the real trouble starts. This creates what you'd call a brutal financial squeeze. As cash flow drops, it becomes incredibly difficult to make those debt payments. The risk of defaulting on their loans just skyrockets. And when that happens, the company's valuation plummets, potentially wiping out the entire investment. So what's the big lesson here? What's the takeaway? Ultimately, this incredibly popular and profitable Wall Street strategy is a model built entirely on the promise of growth.
And this is really what it all comes down to. This strategy creates a direct and honestly pretty fragile link between the financial health of multi-billion-dollar investment funds and the everyday market for air conditioners. The fate of one is now tied directly to the other.
And that leaves us with a final, much broader question to think about. Because look, this isn't just about HVAC.
This model is used across tons of different industries. So if a popular investment strategy relies on this core assumption of endless growth, what happens when that growth finally stops?